Our classroom stock portfolio now has an annual return of 19.06% per year and has grown to $1,922.12 after 120 weeks. Hi, Professor Rex here. We are now a little over 2 years into our class project where we invest a total of only $12.50 per week and split it up to buy 10 different dividend-paying stocks. The market continues to take a breather this week, which is a good thing because many stocks are getting a bit expensive compared to their future earnings streams. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them the accounting concepts in action, starting a little over 2 years ago, each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 a month, into 10 dividend-paying stocks. And because these original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. There are timestamp links in the description of the video in case you just want to jump to the list of stocks we bought this week, or the list of our best performers, or any other section of the video. In 2022, the year we started the portfolio, the market did not perform well, but because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value, as I mentioned, is over $1,922. The return has been 19.06% per year, which is higher than the S&P 500. Last year, the portfolio's return was 28.6%, which also beat the S&P 500. And in the preceding year, the portfolio once again beat the market. So why do we only invest in dividend-paying stocks in this portfolio? That's explained on the next slide. The first reason we stick with dividend-paying stocks is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average has been much lower at 4.27%. The study is updated each year and was recently updated to include the latest information from last year. So go check out the source link that I included at the bottom of the screen if you want more info. Maybe more importantly, historically, dividend-paying stocks have less volatility than non-dividend-paying stocks. It's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks, as measured by beta and standard deviation, tend to be much lower and therefore better for dividend-paying stocks. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. So why do we choose to invest $12.50 per week, which is essentially the same as $25 per paycheck? Next slide explains that. The main reason why we invest only $12.50 per week into the portfolio is because I wanted to show my accounting students that they don't need much money to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck into this portfolio, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation each year. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of $11.74. For a classroom stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total weekly investment of $13.81 per week. A very popular exchange-traded fund that only holds dividend stocks is a Schwab U.S. Dividend Equity ETF, ticker SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our classroom stock portfolio. As of today, our classroom stock portfolio's value is $1922.12. If we had instead invested the same exact amounts into SCHD in the same days, the portfolio's value would only be $1,651.22, a difference of 16.4%. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our classroom stock portfolio. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has at times had large positions in stocks that I consider to be value traps, and I don't want to invest in those. This slide shows our best performing stocks based on when they were initially purchased for the portfolio. Stocks in yellow have been sold. Evercore moved up to the second spot behind only Lam Research, which has a total return of 132% in a little under 19 months. The stock with the fastest rise so far is WK Kellogg with an 85% total return in only 5 months. Also remember that total return includes both the dividends the company has paid as well as an increase in the stock price. Now let's turn our attention to the strategy column, specifically the category called Dividend-Growth stocks. 90% of our investments made in this portfolio were made in these stocks, which means they are high-quality stocks with a great track record of increasing their dividend payouts to investors. The other 10% investments so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. This slide shows our best performing stocks this week, ranging from 14% to 4.8%. In comparison, the overall market fell this week 3.1%. Best performers this week were United Health Group, up 14.1%, and American Express, up 5.79%. Both companies reported positive quarterly earnings this week. American Express reported that revenue increased 11% and profits increased 38%. Also doing well this week were Elevance Health, Humana, Morgan Stanley, and Schwab. Before we look at the 10 stocks we bought this week, here are the 10 stocks we bought a year ago, along with their total returns, which of course includes dividends. I still own all the stocks except the stocks in yellow. As mentioned in a previous video, I sold Robert Half to generate additional funds to invest, and the company seemed to be close to fairly valued at the time, and I sold Fidelity National because they cut their dividend. This is usually a very bad sign, but we still made a 28.5% profit in less than a year. The average return of the 10 stocks I bought a year ago is 31.9%, despite 2 stocks not even being held the full year. Now let's talk about the dividend-paying stocks we bought this week. Here are my ratings for the top 13 dividend-paying stocks this past week. We purchased the 10 stocks that are not in yellow highlight. The stocks in yellow have already grown to be 4% or more of the portfolio, so we did not invest more in them this week because we want to build a more diversified, less risky, and less concentrated portfolio. Remember, each week we buy 10 stocks, and since we are investing such a small amount each week, $12.50 in the first year, it means we're buying fractional shares in our Fidelity brokerage account. This table includes their industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The 2 most undervalued stocks this week continue to be Comcast and Lithia Motors. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. On this slide, I want to show the components to my quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. As mentioned earlier, the other 10% so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. But this week, all the stocks we bought are the high-quality dividend growth stocks. New to the portfolio this week is drug manufacturer Bristol Myers Squibb. Risk is the first quality component shown on the slide, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported earnings, which is also called profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest American Express and Nike. The companies earning the highest financial health ratings are MasterCard, Visa, and United Health. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of recent dividend growth and a higher yield are Bristol Myers Squibb, Interpublic, and Skyworks, followed by Comcast, Starbucks, Nike, and Bank of New York Mellon. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade, dividend growth potential, the companies in the best position to continue to increase their dividends substantially are MasterCard and American Express. The companies with the best combination of recent dividend increases and potential of future dividend increases are Comcast, Bristol Myers, MasterCard, American Express, and Visa. Here's a look at the top 10 stocks that make up the largest portion of the portfolio as of Sunday. American Express jumps to the second biggest position, making up 4.35% of the portfolio. It had the big jump because of the good quarterly earnings announcement this week. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest in one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor. Therefore, we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's return would likely be higher if we always invest in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated and more volatile portfolio, and many investors can't psychologically stick with a volatile portfolio, especially beginning investors. Volatility often causes investors to panic and sell at the worst time possible. Our portfolio holdings are now at 89. That might seem to be a large number of companies to keep track of, but the spreadsheet we have developed for tracking the companies makes it obvious when to sell a company once we download company financial data and accounting information into the spreadsheet, which we do at least weekly, and it really doesn't take that much time. So those are the companies we bought this week. We're trying other strategies too, using real stock portfolios. Besides this dividend growth strategy, we're also running the following portfolios: a high yield dividend paying stocks portfolio. This high yield portfolio currently has a 4.6% yield and is surprisingly beating the S&P 500. I would have thought that a yield that high would not produce enough capital gains to beat the market, but so far it has. Let me know if you want any videos about that portfolio. It was started in August of last year, but the average investment in the portfolio has an annualized return of 37.8% versus 23.5% for the S&P 500. Obviously, those numbers will come down over time. We have a portfolio of stocks with the best competitive advantages, also called moats. Note that all stocks are eligible for this portfolio, both dividend-paying stocks and non-dividend-paying stocks like NVIDIA. And finally, we start a technology-focused portfolio investing in these themes: artificial intelligence, big data, cloud computing, cybersecurity, and software as a service. So in the comments, let me know if you have any questions or if you want to know more about the other portfolios. Also, let me know what other kind of investing videos you'd like to see. And finally, here are the places you can reach me: YouTube, obviously, as well as Twitter, X, LinkedIn, and my website, beatthestockmarket.com. Have a great investing week.